What is the adaptive expectations hypothesis? Adaptive anticipation hypothesis is economic theory which states individuals adjust their anticipation of the future based on latest past experiences and events. In finance, this impact may cause individuals to make investment decisions based on the management of latest historical data, like stock price actions or inflation levels, and adjust the data to predict future action or rates. Comprehending the adaptive expectations hypothesis. Adaptive anticipation hypothesis indicates that investors will adjust their anticipation of future behavior based on latest past behavior. In case the market was trending down, folks will probably expect it to continue to fashion like that because that's what it's been doing in the recent past. The propensity to believe this way is to lose sight of the bigger, long-term trend and focus instead on recent detrimental as it may cause individuals and the anticipation that it action and the expectation that it is going to continue. In reality, many items are mean reverting. If an individual not capture signs of the turning point and action, they might not catch signs of the turning point and certainly will lose out on opportunity. This hypothesis, where previous beliefs are updated like new info arrives, is a good example of Bayesian updating. Nonetheless, leads to overconfidence that the trend will continue indefinitely, which they've happened might leads to overconfidence that the trend will continue indefinitely, which might lead to asset bubbles. Samples of the adaptive expectations hypothesis. For instance, before the housing bubble bursts, home costs had been enjoying and trending up for a considerable time length in many geographical regions of the US. People focused on this fact and assumed it'd continue forever, so that they leveraged upward and purchased assets with the assumption that price mean reversion wasn't a possibility because it hadn't occurred lately. The cycle turned and costs dropped as the bubble burst. As another example, if inflation over the last 10 years has been operating in the 2-3% range, investors would utilize an inflation expectation of the. Consequently, if a temporary intense fluctuation in inflation happened lately, like probably, the opposite would happen in a need pull inflationary environment. What is the adaptive expectations hypothesis? Adaptive anticipation hypothesis is economic theory which states individuals adjust their anticipation of the future based on latest past experiences and events. In finance, this impact may cause individuals to make investment decisions based on the management of latest historical data, like stock price actions or inflation levels, and adjust the data to predict future action or rates. Comprehending the adaptive expectations hypothesis. Adaptive anticipation hypothesis indicates that investors will adjust their anticipation of future behavior based on latest past behavior. In case the market was trending down, folks will probably expect it to continue to fashion like that because that's what it's been doing in the recent past. The propensity to believe this way is to lose sight of the bigger, long-term trend and focus instead on recent detrimental as it may cause individuals and the anticipation that it action and the expectation that it is going to continue. In reality, many items are mean reverting. If an individual not capture signs of the turning point and action, they might not catch signs of the turning point and certainly will lose out on opportunity. This hypothesis, where previous beliefs are updated like new info arrives, is a good example of Bayesian updating. Nonetheless, leads to overconfidence that the trend will continue indefinitely, which they've happened might leads to overconfidence that the trend will continue indefinitely, which might lead to asset bubbles. Samples of the adaptive expectations hypothesis. For instance, before the housing bubble bursts, home costs had been enjoying and trending up